We are live. All right. Hi, everybody. Happy Friday. Happy Gumboot Friday, everybody. Yeah. And we've got Samuel Eva joining us. Hi, Sam.
Kia ora, bro. How you going?
Yeah, very good. All right. Let's start it off with the video clip, eh? How's that? Yeah. It just
That's
shows
good.
everyone who they're watching. All right, before we get any further, the second most important thing beyond the introduction is the disclaimer. So anything we say in this video is not meant as personal financial advice. Don't make serious financial decisions based on our random Friday chat, but feel free to get in touch with Samuel if you do have any other questions. That is our disclaimer done. All right. Yeah, that's right. For anyone that didn't realize, don't make decisions off YouTube or Facebook.
Yeah, give us a call. That's it.
Yeah, anytime. But we have had a interesting couple of months. Well, it's been a month since we last caught up, and of course, it's been really interesting. We're going to focus mainly today on interest rates, because I think that's hot on everyone's mind at the moment. And we should say that while we're live, post any comments you got, and we'll pick them up. Any thoughts you've got on interest rates, where they're going, we'll happily fight you in the comments section for based on our knowledge. Sammy, what have you seen in the market, mate?
The market has really heated up. I think that's taken a lot of people by surprise. It seemed like we came out of lockdown, not as always with uncertainty, and people are just really fighting tooth and nail for homes now. It's really important that you're putting your strongest foot forward. Prices are just through the roof, and of course interest rates, which, as you mentioned, we're going to talk about in this session, on the up as well. So not only are house prices on the up, but interest rates are on the up.
It's real interesting, right, that interest rates are up by 1.2%. Well, I've got the numbers behind me, but let's say it was 2.19 in June or July, and now it's 3.35, so 1.1% ish. That historically, I mean, it's been at 9%, so 1% isn't much, but on the other hand, it's up 50% from what it was, and that's probably the killer, right?
Well, not just that 1%, or sorry, that 50% jump that we're talking about. It's also the house prices. 9 years ago, we didn't have a mortgage. We had a $200,000-$300,000 mortgage. We're now writing mortgages $700,000, $800,000, $900,000. All of a sudden, 1% on that, you're gonna feel that.
Yeah, $9,000, right? $9,000 extra of cost. You've got to earn $12,000 to get it. It's brutal. Yeah,
it is brutal. Just on those interest rates as well, it's right across the board. A lot of people are talking about that short term, 1 year, 2 year, right? But we are seeing rises right across the board, with the 3 year, 4 year. And I know that we touched on those rates a month ago in our last podcast.
Yeah, I mean, let's have a look at it. What we got recently, 4.65 for 5 years. And in sort of June this year, we were getting 3.19. 3.19 to 4.65. Yeah, it's the 5 year is now was cheaper than the 1 year is now, which is I don't think anyone was brave enough to take 3.19. Certainly not many of the clients I saw come through.
No. A lot of my clients have been, hey, we want to be fixing for that shorter term, that 1 year, that 2 year. And I think that was sensible a year ago when we saw the downwards trend. But I think you've definitely got to be questioning that 1 year rate at the moment, wanting a bit of security in that middle to longer term, that 3 to 5 year term.
Yeah. And it's worth discussing, it's not just about the term, but also what you're planning on doing with your house. I mean, if you're planning on selling in 2 or 3 years, then 5 years might not be the thing. But
Mm.
it might be. We might be in a property cycle that is people just stay put, and don't move. One of the things we're finding is, of course, that people want to move, but there's no stock. That would you say that's a common thing? I didn't actually mean to bring that up, actually. Sorry, but yeah,
That's-
seeing as it's your personal experience, that's tell us about
so
that.
for our returning viewers, you may recall that I had just sold my property the week before our last podcast, and here we are a month later. And the prices are, on average, I would say, have jumped up 100,000 just for what I'm looking for. I would argue that I'm still in that sort of first home buyers range, that $1 million home. Some of the results that I've seen over the last 2 weeks have been absolutely ludicrous, the offers that have been coming through. And it's coming from a range of the market. We can be a little bit hard on developers, but we've also got emotional first home buyers and emotional upgraders or downsizers, that want top dollar and whatnot. So it's right across the board. I don't think there's many deals out there, trying to find that cheaper deal. I think right across the board, you're looking at $1 million plus now, and in Auckland, that is in Auckland. Chat.
Yeah, well, it's in Wellington too, and Hamilton, Tauranga for sure. It is $1 million.
Yeah, did I believe I read an article, I think it was on Tuesday, a real estate agent in Brighton, Christchurch, talking
$1 million.
talking about the property rises were just superseding their expectations, and this was a real estate agent that did not want to put a price on a property because he just felt he could not confidently advise
Guess.
what this guess
Yeah.
what this property could go for. And I think that will speak to a lot of markets at the moment.
I mean, about 3 years ago, I wrote an article for our blog, and you can search it on mortgagelab.co.nz, about what you get for $1 million in each city, and it was the main ones, right? So, Auckland, Hamilton, Wellington, Christchurch, and Dunedin, and what you get for $1 million in Dunedin is significantly. I could only find multi-unit properties to get there. Not true anymore. 800,000 in Dunedin will get you a nice house, but $1 million, not much more, right? So yeah, it's interesting.
It is interesting because Dunedin, I think, is going against the grain in that they're losing industries faster than their building industries. Unfortunately, with Cadbury chocolate pulling out and whatnot, I think a lot of people were worried where Dunedin was going to go. I know for me and my clients, I've seen a lot of parents start buying their first rental down in Dunedin. There's a very strong student base there. Students are always looking for places to rent, and that has put on the demand up down in Dunedin as well. So Dunedin's a really interesting one.
It's driven by the students at the moment.
Well, it's really the only industry down there at the moment. Is there? I can't think of any
hate
other
comments from Dunedin.
Dunedin, I love you.
Yeah,
I love you, Dunedin. It's a beautiful city.
Yeah, it's fascinating. It's great. Yeah. I think it's worth pointing out while we're talking about interest rates, because a lot of people have seen for the past 10 years, OCR goes down by 0.25, interest rates go down by 0.25 or 0.3 or whatever. And so in the past 3 months, we've seen OCR go up by 0.25, interest rates go up by 1.25, and it's suddenly becoming clear that the fixed rate swaps, which is actually where the bank gets the money from, have already priced in future OCR rate announcements. And that's what's been so confusing for people, is they thought, oh, the OCR has gone up by 0.25, it'll go to 2.45%, and suddenly we're up at 3.35% or 3.5. I think we've seen 3.5. Yeah, a little bit confusing, but I think for the next OCR rate rises, we may not see quite as a larger response from the
Sharp
interest
jump.
rates. Yeah.
Yeah.
Hopefully.
Yeah. Yeah.
It's tempting to blame the banks. It's tempting to say, oh, the banks just want money, but actually the fixed rate swaps are what prices mortgage rates. So yeah.
At the end of the day, they've got to cover their costs, right?
Yeah, I mean the bank's doing fine. They'll be fine. I think $1 billion for a couple of them in a quarter. Yeah, but we won't get into that. That may get some people. What we could probably bounce around, and this is what most people want to know, is if they've got a rate coming up in say 3 or 6 months, what do we think they should probably do? What's your initial thoughts on that?
So my initial thoughts, and Rupert, you touched on this earlier, something that us advisors do, we always try to look at the bigger picture. So we're going to really try and knuckle down what you're trying to do. Now, none of us have a crystal ball. If you asked me in January this year, are you going to sell your house this year? I would have said no. Absolutely, I would have. It was not on the agenda. Here I am 11 months later, sold my house. So we do talk about that, and really through that discussion is what we might be able to recommend to you. So if you think you are going to be on the move soon, then we might look at a 1 year, 2 year term, something to cover you in that short term, right? If you did say this is the family home, I'm not selling for the next 20 years, then we might look at the costing of fixing you for 5 years and what that means to you. Now, why do we look at that shorter term if you are looking to sell? Break costs. So when a bank gives you their mortgage, they are putting down in their projected income, we're going to make this much money from your mortgage, right? If you are to break that contract, there is obviously a break cost to that, and that is worked out differently due to length of term left on your contract, or if you are going to be going to a cheaper rate or a more expensive rate, or there's a lot of things. Unfortunately, as advisors, we can only get those rates from the banks. We do not have their break cost calculator.
Wouldn't that be great? It'll make our life so much easier.
Oh, it'd be fantastic. But yeah, so it really does come around to what is your intentions in the next 1 to 5 years. That's for me.
Yeah, it's not this formula, but a really good place to start is, what have they lent it to you at? What have they lent it to you at? What are you borrowing it at? And so what's the loss going to be? So if you were currently on 4%, you break it and they do a 3%, that's a 1% loss to the bank. If that's over 6 months, it's going to be 0.5% break fee, essentially. Now that fluctuates dramatically depending on the fixed swap rates, but it's a good place to start. And we actually have a calculator which we'll bring up. Right, that is my first screen share on this live stream, and it's good to see no one got cut off. And yeah, we're still here, and this is literally what we're figuring out here. So if we had 400,000 at 4%, and you were due, let's just say it's 12 months away, and you were now taking 3.35%, you're going to save $2,600 over the term of your loan, and it's probably going to be about the same in terms of break costs. But if you can get that rate to, let's say they come back and say, no, it's $1,000 because of what we're getting the interest rate at, that's where you can arbitrage that interest rate essentially and make quite good profit on it. Now we also throw in what would this be if we refinanced it, because often going to a new bank after say 4 or 5 years can be financially beneficial for clients, particularly if they're unhappy with the service of their current bank, or they feel like there's a product at another bank, like an offset or something, that can more suit their needs. And then we add in and calculate. So if we said the break costs were $1,000, this client would be $2,900 better off over the next year by moving to a new bank. And that's essentially how we calculate. There's nothing, no secret sauce in it. But yeah, it's really interesting. Those break cost fees, how they really affect that calculation.
Yeah, absolutely. And look, there'll be times where we request those break fees and we start scratching the old grey matter. How did they get that?
Yeah.
But we do have that direct line to the bank to say, hey, we need a bit of discussion around this, which is good.
Yeah, the worst one I've ever had was we broke the second tier lender to go to a new bank, mainstream bank, because they now met the criteria of mainstream bank. Second tier lender said, "Oh yeah, that will be $5,000 and change." And I thought, man, that is cheap. I was expecting about $15,000. And it came to the documentation stage, and they said, "Oh, we made a typo. It was $15,000. Well, sorry, you promised 5,000." So, yeah, that was. But
and they honored that.
Yeah, they did actually. Yeah. So, but you can see it wasn't outside the realm that this could have been $5,000. It was just way less than we were expecting. But it's really interesting how it's doing it. But I mean, it costs nothing to find out those break costs, and so I would encourage anyone watching this video to just pop your advisor a line or pop Samuel a line and say, "Hey, can you get me these break costs, and let's just do some calculations."
Yeah.
Yeah.
Yep. Nice and easy.
Yeah, and a scenario I was running through with a client this morning was, their rate is coming up in 6 months' time. What do we think the rates are going to be in 6 months? It would be anybody's guess. Happy to hear feedback from anyone, but yeah, if you definitely know, you're lying, because we don't. But is it worth breaking now and paying? Let's say he's on 2.3. Going to 3.3, but locking in 3.3 with the view that it's going to be 3.8 in 6 months' time. So he's paying a premium now to sort of head off those further rate rises. And look, we've got to be clear, it's a guessing game. As you say, it's crystal ball gazing.
Yeah, absolutely. I mean, even the economists that get paid the big dollars have been getting this wrong for the last century, really.
Yeah.
It really is. Hey, we think this is what's going to happen because history tells us. Thing is a global pandemic and globalization of industries is just really, there's no reference point back into the past that we can go to. So it really is a guessing game.
Well, I mean, I always say that I think every economist speech should start with what we know now, because you can forecast whatever you like with what you know now. But if as I say, a pandemic or Donald Trump gets in or a war starts or something, all bets are off the table, and that stuff happens all the time. Yeah.
Yep.
So it's easy to breed up the economists, and to be fair, they do shout from the rooftops when they nail it. So you've got to give them a bit of stick. Yeah. If you read my yearly forecast of interest rates, you'll see that I have about a 0 for 4 strike rates.
That's a great record, mate.
I've taken just to updating it rather than leaving it up there and just I've got it now.
Yeah, there you go.
Cheating the system. Yeah.
Look, I'm just not confident enough to make the call. It really is. Look, from what I know now, from what I've seen over the last 3 months, this is what we're expecting.
I think you would say the risk is towards the upside. So if you had to make a bet for this time next year, it seems more likely it would be, to say it's 3.3 now, it seems more likely to be over 3.3 than under 3.3.
Well, I think, yeah, absolutely. I think, all the major economists, the bank's economists, but also the independent economists that I tend to read, they're all pointing to much higher rates next year, and that is cause concern for the market. I believe, and the way that money is going to be lent, if you are a new home buyer out there, that process, not just with the triple CFA, which we covered in our last podcast, but the test rates and all that kind of stuff is really going to change.
Yeah.
Mm.
Yeah. I mean, they are going to want to know that you can afford a significantly higher interest rate, and that it's always been, even when it was down at 2, the banks were testing at 6. So if it's up at 4, they're going to want to know you can pay at 8, and that's part of our August promotion that we do, which is the aim for 8. With August being the 8th month, it all works. That you should aim to be able to pay off your mortgage at 8%. And look, no one's blaming you if you can't today, because it's 2, so why would you bother? But if you can move towards that, then there is no interest rate shock in the near future.
Great advice.
You've done a bit of looking overseas at interest rates. I did an article recently on US interest rates fixed for 30 years. How good would that be?
It's beautiful, right? It's beautiful, but it is important to point out as well that that's not available for everyone, right? The 30-year term, actually the history of the 30-year term, they used to be called GI terms, and they were only there for the Vietnamese War veterans. So in America, loans are still written for 10 years. I'm currently looking at Anaheim, one of the greatest places in the world.
Because of Disneyland.
Because of Disneyland. But whenever I talk to the advisors over there, it's always 10 years. I like, me personally, I cannot get a 30-year term.
And you're talking 10-year print term of you've got to pay off that mortgage over 10 years.
Yes, correct. Now that is slowly changing as well, because house prices going up through the roof are not subject to New Zealand only. At Anaheim,
looking at you.
Yeah, well, even Anaheim, looking there 2 years ago, a beautiful 3-bedroom townhouse with a common green, common pool. You're looking at 300,000 NZ, and 2 years later, you're now looking at 600. That's is a complete double of what the market's there now. Of course, you can still find a state, I don't know, Arizona, and probably pick up a mansion for 100,000. Why you'd want to live in the desert, I don't know. If you're watching from Arizona, I love you guys. Don't crucify me. Yep. But yeah, so the 10-year term isn't, it's not a big scary, it's controllable. But of course, those 30-year terms, as banks do move to opening up that market, and they had been doing that even back in the early 2000s after September 11. Of course, there's a big financial crunch, and people walking away from their houses. It's a very different market to New Zealand. And banks did successfully lobby with the government at that time to say, hey, we actually need to be opening up these GI terms to people at risk, basically. And so that's what they've done. But amazing rate for sure.
3.3 or whatever for 30 years. And their break fees are capped because of the Dodd-Frank Act. That they're capped at 2% of the mortgage, which I can't imagine many New Zealand banks being stoked about. I think I've seen a 6% break fee. Over $1 million.
It definitely is a different game, and no reflection onto our New Zealand banking partners, but the way that American law and legislation works, they tend to protect the homeowner over the home lender. Again, no reflection to New Zealand. play with what we have.
Well, there's a little bit of a state of mind as well. I think that the Kiwi population likes those shorter terms. I'd like to kind of, if they were offered 3.3 for 1 year and 7% for 15 years, I wonder how many people would take the 7%. And I think you'd find that the banks proved that they actually do, the shorter term kind of one was preference. But I don't know. I'd love to. If anyone's got any comments about what they would pay, what premium would you pay for 15 or 30 years? What would you pay to lock in a 30-year rate?
Yeah, that's a great question. I mean, I guess when I bought this house 5 years ago, my 1 year rate was 5.2%. The 5 year term was about that 8%, which of course, aim for 8 in August. Would have I locked in a 30-year term for that 8%? Yeah, probably, knowing what I know. Hard to know. But we know that it's going to be a higher rate than that. So you're probably looking at 11, 12%. Well, really, I could not afford that. Simple as that.
Now, right? Yeah.
There was a New Zealand-owned bank that did 10-year terms. I don't know if they still offer that.
We're not going to say its name, but let's say it's based in Taranaki.
Yeah.
I don't think that. Well, so I remember they came out with a 10-year rate, and that was, when everyone was at 5.6%, it was like 7.2. That was a 10-year rate. But then, of course, interest rates have come down. But, hindsight's 2020. Everyone was saying this is the bottom. How could you get any cheaper than 5.6 kind of thing? So, yeah, it's.
But I mean, given what we know at the moment, if they came out tomorrow and they said, right, we're doing 1% per year, so 10% for the next 10, for a 10-year term, would you look at it?
Yeah, I don't know. I mean, my gut feel is mid-6s to 7. I'd be happy with that.
You think that's where we'll settle?
Oh no, I think that's what I would pay. That's no forecast of anything. That's just where I'd be comfortable paying for the next 30 years.
Trying to put you on the spot here. No.
That's right. Yeah, make a decision. But I reckon mid-7s for is what I would pay for a fixed term for 30 years. Because that seems to have been the long-term average. A lot of economists would argue the days of 10% plus are gone, but I think it's probably enough to be comfortable. What would suck in this 30-year average rule would be for about 5 years, your neighbor's going to say, hey, what rate are you on? I'm on 3. And you're going to say, I'm on 7. Yeah. And then in 10 years' time, you're finally going to get smug and
well, and I think that's when it does start to pay dividends, right? It's in that longer term, because it does give you that certain security. 6%, 7%. I know that I can afford that, and hopefully, I'm not going to be getting a pay cut anytime soon. So it's going to be something drastic that really, knocks me from that 6%, 7%. And then, of course, with inflation, if you wanted to add all that in, I mean, 3% in 10 years' time is still going to be a lot of money, isn't it? So
yeah, well, I mean, inflation is sitting about 4% at the moment, isn't it? So it's yeah,
it was quite high last. I mean, that's what triggered last month's OCR, wasn't it?
Yeah,
so quite high.
Yeah.
Cool.
All right. If you this video will be up after we've closed down this live stream. So feel free to put your thoughts on what you'd pay for 30 years or where you see the interest rates going in the next year or two. We're always keen to crowdsource that information. Anything you want to leave us with, Samuel?
Not particularly, but I do want to say GG's to Rupert for growing that slug. Or is it that way?
My 5-day Movember.
Movember in 5 days. This is my Movember in 5 days. It's not smudge. It's an attempt.
That's right.
Hey, no, big shout out to Gumboot Friday and I Am Hope and all they do for youth mental health, and a big shout out to Movember. And all they do around men's mental health and men's cancer. I believe we've got a graphic for Movember happening this month.
Oh yeah, watch the logo for watch the
Awesome.
Mortgage Lab logo as that moustache grows. Yeah, you don't want
Yeah.
to see me without a beard. It's horrendous. So we'll put the
I'd pay
logo.
7% for that.
Good. If we get enough, we raise $1,000. I'll shave the beard.
Challenge.
Yeah.
Done. Challenge. Let's go.
All right. Thanks everyone for watching, and thanks Samuel. We'll have you. We'll jump back on live again in a couple of weeks and have an update
Sounds
where
good.
everything is.
Awesome. Thanks everyone.
See ya.